tough market, but by trying to think outside of the box. So by going to markets like not a lot of people will consider attractive, or with deals that might not be the best fit for their current criteria, as we're trying to get good deals.
Welcome to the Deal Flow podcast. Today, we're excited to welcome Eduardo Viesca, a seasoned real estate executive and investor. Eduardo specializes in providing debt and equity solutions across various real estate asset classes with a strong track record in multifamily, mixed use, and industrial assets in the U.S. and Latin America. His career includes founding Manglar Capital, where he focused on residential opportunities, and serving as managing director for Allsys Funds, managing significant investment initiatives. Today, he joins us to share insights from his dynamic career and discussing evolving trends in the real estate investment niche. Eduardo, thank you for taking the time to be with us today.
No, thank you for the time, Michael.
I gave you a little bit of an intro there, but maybe from your own words, if you could tell us a little bit about your background and your experience, in the real estate space.
I'm born and raised Mexican. My whole career has been in real estate. Started in private equity real estate in Mexico, out of the Mexico City office for Prudential Real Estate Investors. Now it's PGIM. And then I moved to Miami 30 years ago with Allsys Funds. And I was doing investments, all around Latin America, the US, and a little bit of in Europe as well. And then I started my own shop in 2016, Manglar, initially as an advisory firm, but then we started doing our own investments. Now we're more of a family office type of structure. So I've been on, I would say, both ends of the spectrum. So I've been an institutional investor, I've been a developer, I've been in the middle as a broker. So, anything in between. What we learned that it's the good from those three areas, we try to apply it here in Manglar,
Thank you for your background on that. So Manglar, tell me, you said you did some advisory work. You're also, investing as a principal on behalf of, LP Capital. Tell me kind of what you're working on today, and then we'll kind of go backwards. We'll go back to your beginning, but tell us a little bit about what you're working on today.
I mean, nowadays, honestly, it has been really difficult to make deals pencil out, what the rates are, especially because we do both development and acquisitions. We just, for the last, I would say, 18 months, have had more traction on acquisitions rather than on developments. But interestingly enough, we're about to close on a development deal, which is completely, different than what most of investors would consider development. We're getting into land development. We found a partner that is heavily focused in Wichita, Kansas. And what we're doing is buying lots of land, getting the infrastructure money from the city. And basically that money is going to get paid back from special assessments from the people that will actually buy a house on those lots. So basically, we're just buying the land, getting the city involved. We don't need to pay for that infrastructure, but we still can sell those lots as if we were the ones putting the money for the infrastructure. So we're getting pretty decent returns, like 30% plus type of things, 1-2 years of holding period. So we're getting, good traction with those. The idea is for us to continue doing like 2 or 3 deals per year in that market. We're open to other Midwest markets, but our partner has a very good footprint in Wichita, and that's what we're doing. So right now we're being very, very opportunistic, like with this type of deals. On the acquisition side, we're trying to find a good story behind the deal, any deals that we go after. Like the best deal that we have done over the past 18 months have some sort of, a component of seller in a stress or distress situation, developer that decided to do their own property management and now they're struggling to lease up. So we were able to get significant discounts on those acquisitions. So rather than being a value add play, it's more of a management play. But those deals, if you were to buy them on a normal market, would show core plus type of returns, and we were getting opportunistic returns. So that's the alpha that we're trying to achieve by going after very opportunistic deals. We're saying no to a bunch of deals, but those are the ones that we're liking. And we're always trying to do very conservative underwriting. Whatever our partners present, we need to stress it because on Excel spreadsheet everything works. So we're trying to be very, very conservative. I'm not driving my investment decisions on IRR right now because who knows where the cap rates will end up in the next couple of years. So it's more of a yield on cost, cash on cash type of play right now. Although we do want to see a good IRR there, but the main drivers of our investments are basically the spread that we can get from a yield on cost and our cap rate at exit. So yeah, that's what we're doing right now. It's tough market, but by trying to think outside of the box, going to markets that not a lot of players found sexy. Even though I'm based out of Miami, I wouldn't touch Miami right now. It's too expensive, in my opinion. So by going to markets like not a lot of people will consider attractive, or with deals that might not be the best fit for their current criteria, as we're trying to get good yields,
Yeah, no, that makes a lot of sense. There was a lot in there, so I was taking some notes to make sure I could touch on most of what you said there. So I guess starting with the first thing that you said on the opportunities where you're working with cities and municipalities through a local partner, and essentially the city is giving you what is effectively financing or a bond that when you sell the house, it gets paid back to the city. And those development fees, what percentage of the capital structure is that, right? You've got your soft costs, your hard costs, those infrastructure costs. Is that 10% of the project costs that you're sort of eliminating effectively?
Yeah, since we're not building the house, actually, we're just selling improved lots. Basically, the infrastructure money is 90% of the money that we need. The other 15 is just the land that we're buying outright, cash. There are certain requirements that the city asks for anyone that's trying to do this. Like you need to be a reputable developer in your area. You need to post, letters of credit for 35% of whatever money they're giving you for the infrastructure. So there are certain requirements that you need to come up with, but we could go and develop the houses. But for me, if you're ready to make a return, maybe we can keep some lots for us to develop. But if I'm already achieving the value that I intended when I started investment, I'd rather take the money and then recycle it and go for another one,
Take the part of the deal that has the highest slope, right? The best returns, right? If the vertical construction's hard, and the returns are not as good as some of the other earlier stages of the development process. So that's great. How many lots is that, just to get a sense of the size of projects that you're typically doing?
250 duplex lots, so you will get like 500 units there. We're looking at some smaller, like 70 duplex lots, and then we have some others that have single and duplex, around 200 or so. So it varies depending on the land that we can get.
But kind of the upper side of the middle market, basically, like up to 50 to 75 million is the completed on the other side of the deal, right? Not where you are in the process. But
correct. And the interesting thing is home builders don't want to, or they don't like to get involved in this land development side of the business, which to me is a little bit mind-blowing because, you're leaving a lot of money on the table. Their cash flow profile or whatever, it doesn't match with what we're doing. So basically we're getting approached by home builders to buy the whole entire phase from some of our projects just to, get themselves, work for the next 2 or 3 years. rather than doing them themselves. Probably it's harder for a home builder to park some money on this type of project because it takes time to involve the city, etc. But there are not a lot of players doing that in Wichita or in Kansas City that we're also getting involved. It's a great opportunity for us. As long as we can take advantage of it, we will probably continue doing it. I mean, to me, it's a better risk-adjusted return doing that than to going on a completely ground-up development that I can barely achieve a 7% yield on cost, after completion. So to me, it's shorter term, way higher returns, cash flowing, different than a typical development. So yeah, we're having fun doing these new deals,
Yeah, absolutely. So moving from there, you spoke a little bit about IRR and cash on cash and yield on cost. Maybe you speak a little bit to what are those thresholds that you guys are looking for? Because I know you had said that, IRR, it's so dependent on the exit. So you really have to try to peg your exit cap rates, which is it's always very difficult to do that, right? But in today's environment, not only is it difficult, but no one, investors have been burned before by, assuming, hey, we're going to go out at the same cap we came in or even a lower cap. And so, maybe could you speak to what are you seeing now as it relates to what your thresholds are on yield on cost when you're doing, I guess, more of a development deal or an acquisition of an existing property?
Or starting my career on the institutional side, I always see a deal if I were to present it to an institutional investor, right? So I always question my models as if I'm going to invest in those. Or whenever I receive a deal, I always go to analyze the same type of things. Like cap rate compression is a no-go unless it's completely justified, right? Like if you're buying an incredible asset that, your basis is super low, and then if you're buying at a 9% cap rate going in, but just because you're getting into a completely destroyed building and you need to redo it, then you can justify a cap rate compression. But if a guy is buying a 1990s apartment building in Georgia, and he's getting into a 6 cap and he wants to sell it in 5 years at a 5.5, I mean, I would have to adjust the cap rate and see if that would work, at a 6.5. At least I want to see some sort of a quarter point or half a point type of expansion. So to me, that's the first thing. Like whenever I see a cap rate compression, is that you're justifying something in your numbers that is not working out. And the yield on cost, I would say, I like to see close to a 7 nowadays. Ideally untrended, especially on ground up development, which is super hard to achieve nowadays. Like I haven't seen a bunch of those. You can get close to a 7 on acquisitions, and that's where we're trying to look for. But it all depends on your business plan. We're not getting involved in heavy value add that can put a lot of risk on the execution of that business plan. So what we're trying to do is mid to light value add, proven rents increase, basically, either from the seller or from actual competitors, because sometimes we see deals that the guy is buying a 1990s product and he's comparing to early 2000s. Like to me, it's like and they're not even close to your location. So for me, it's you need to be reasonable with what you're trying to present. I understand that everybody has the need to continue acquiring properties to keep your operation. But for us nowadays, we're trying to be very conservative. So yeah, yield on cost above a 7, ideally untrended on development, if not close to 7 for acquisitions. Really, really understanding that you can achieve those rent bumps without pushing it too much. And yeah, going in cap rates, I think it would vary depending on the opportunity. But everything that I've said should translate to a mid to high teens type of IR. after adjusting everything that we received. And that has to take into account like reasonable insurance expenses, which nowadays, especially for example in Florida, certain areas in Texas, Georgia, is ridiculous. It's killing a lot of deals. And also property taxes. I mean, we have had experience with how affordable deals where we get involved with a housing authority, like in Houston, for example, where we can get a tax abatement in exchange of getting certain percentage of the units under AMI, 120% AMI or something. And that way, we like those type of deals. And we also like some deals that we can get involved in, if the affordability is expiring and we can sell it to a buyer that is interested in releasing that affordability component. And, we can achieve a decent return by doing that. So, I would say returns are a moving target depending on where we are. But we always try to go deep into the underwriting and understanding what our partner is trying to do.
Sure. And so you mentioned a few times partners. So is that typically how you're structured, where you're really overseeing the local partner who's actually doing the operations, the acquisitions, and they're bringing you opportunities, and then you're representing and kind of doing your own level of underwriting and then representing your capital in those deals? Is that correct?
For the last 2 years, that's what we have been doing. Although we have some deals of our own, mostly developments, we have them on hold. The numbers were not penciling out to a return that I was feeling comfortable without stretching, my rents too much. So we're not rushing on those deals. But since the market started to slow down, we increase our, LP, co-GP type of investments. And that's, we're trying to find good local partners with boots on the ground, with good relationships in those markets, that it will be really hard for us to get those deals or negotiate, those tax abatements with the housing authority without losing scope of what we're doing on our other projects. So for us, it's finding a good partner that we can trust, that we can see eye to eye and share, our vision.
So I guess when you're looking for partners, it sounds like you're looking for folks that have some sort of unique edge, right? They have some unique experience or discipline or expertise that they've developed over a long career, and then you're able to basically come into that, without having to do all of that work of gaining that expertise, and then sort of leverage that and help your investors capitalize on their expertise. Essentially, is that correct?
Exactly. Like, becoming their financing partner, basically. They focus on finding the deals, and ideally we can bring most or the majority of the equity to the table.
Sure. I got some questions about markets that you had mentioned, but, I guess while we're on the topic of partners, how do you, structure deals with partners that you work with, and how does that relation come to be? Do people come to you? Are you guys constantly looking for new operating partners, or do you develop relationships with just a few folks in these various verticals and then, have a programmatic relationship? Kind of how everyone kind of does it a little differently, looking for one opportunistic deal or looking for programmatic investment. How does that look like for you guys? And then how are those deals typically get structured on your end?
I would say it's a combination of all of the above. Like it's a lot of relationships that I have in the past, and we receive a bunch of deals from equity brokers as well. That's a good way for us to stay active. But for us, it's, I don't mind if the company is, new, as long as the partners have good experience, being principals at a different company, that they know what they're doing, and, because at some point we were also starting, and you always look for that partner that can help you get to the next point. Like, I tend to say no fast, but I always give myself the opportunity to analyze the opportunity and the partner. And if that specific deal doesn't work, at least start the conversation and, keep in touch for the next deal. I wouldn't close myself to meet a new group or to meet someone that has a new idea. Like we were looking at an office deal a couple of months ago, which has a completely contrarian view, which, that local partner has a tremendous experience in that local market. And, the deal was very interesting, although we couldn't make it work because of timing on other closings that we had. But it's just about learning what other guys have figured out, and if we can make that fit to our investment criteria, I think we will find a way to make it work.
Cool. Well, I think you had mentioned a little bit about Houston, and you touched on Florida and Georgia and Texas. Are you guys, but it also sounds like you're mostly opportunistic. So it's mostly a bottoms up type of analysis. You've got your filters and your return dynamics that you're, looking at. But do you focus on any specific locations in the United States, or, what is that thesis? Or is, again, completely opportunistic and you'll kind of go anywhere?
The Sun Belt, primarily our focus, and the Midwest, we won't do, or probably won't do, a deal on the West Coast. We try to stay away from the Northeast. So anything in between, I'm open to take a look. So I like Texas a lot. Austin, I love that market. Now maybe in a couple of years, I will probably do another deal there. But, San Antonio, Dallas, Houston, and there are other smaller markets in Texas that I like. Florida, I would say Orlando, Tampa, Jacksonville in certain pockets. South Florida for me is really tough to feel comfortable with everything compared to the other opportunities that we're seeing. We have some land in Bentonville, Arkansas. I really like that market. I think that market it's growing very interestingly. We're in Kansas now. We're gonna be in Kansas in the next couple of weeks, in Wichita, potentially Kansas City. We're looking at deals in Indianapolis. So I would say it's driven by the deal, by the partner, and the business plan. So anything in between, I'm happy to take a look.
All right. So it's sort of like you're looking at the sponsor first and the strategy, and then the market is sort of the next level after that. And then you look at that individual opportunity, and that's kind of your lens and how you look at things.
Correct. Maybe that specific deal won't work, but at least I start the conversation with that guy, learn what he's doing in that market, and maybe the next deal will work.
How do you guys process through opportunities? So like you had said, a lot of flow comes to you because you're kind of on the buy side, right? You're on the capital side. So people are coming to you with opportunities. But once that opportunity comes into your shop, into your, world, what happens next? I mean, what does that process look like? Do you have are you underwriting those deals? Do you have a team that's working on this? And maybe just walk me through, your process from, that opportunity hitting your desk to closing the deal if you guys end up moving forward. It's just a high level, obviously.
I would say I'm the first filter. If I receive an email and I can just glance over it and see, okay, this might work, then we send it to an analyst that works with us to really dig into the information. And if it works, then we start, analyzing if the timing will work with what other, projects we have going on. And typically, if it's a no, I would rather give it super fast. So don't create false expectations or just waste other people's time. But if we want to move forward, our process typically takes 30 to 45 days. Because we're not structured as a fund. So we have investors always looking at our deals. But, it takes time, especially with Mexican investors. They're not used to the same dynamic of a closing timeline like the one we have here in the US. In Mexico, it's more of a artisanal, more of a romantic type of process that they, take their time. It's completely different. And sometimes it's hard for us to make them realize, like, listen, if we don't close by this date, we might lose the deposit. So there's a lot of things at risk. So that's why, having my partners in Mexico, help us navigate through that process with investors. But we try to align ourselves to what the closing timeline of the deal is. And if we're moving forward with the deal, ideally we need to come to terms with the sponsor before their money goes hard. Ideally, if we get involved soon enough. And for development, of course, you have a little bit more time, but we always try to move as quickly as possible. Especially because we, even though some of our investors are a bit more structured, the other guys, something might happen in between that they commit to your deal, and for whatever reason they need that liquidity somewhere else, and you're stuck with a hole in your capital stack. So the sooner that we can get the money in our bank account, the better.
Typically, it sounds like you're working with a lot of overseas non-U.S. investors. Are you typically working in dollars? Are they investing in dollars? Are you having to deal with currency risk or any sort of exchange risk, or kind of what does that look like?
Yeah, no, it's 100% dollars. We receive dollars and we send back dollars. Most of the investors that we work with are trying to leave their money in the U.S., or the majority of their money that they invest with us in the U.S. And part of the services that we're doing now as a family office specialized in real estate is we have a local partner in Mexico that helps each individual investor, depending on their needs, to create a tax efficient structure for them to invest in the US. So it's either an inheritance issue or whatever corporate structure they have in Mexico. We try to work around that to create a tax efficient solution for them. Before adding this partner to the mix, we were just pointing them out to whoever we thought was the right person to help them. Because the number one question for these guys is, what about taxes? I'm afraid of the IRS, or the FX is a little bit volatile nowadays for the Mexican peso. So it's like, first, we're not FX traders, and you shouldn't be unless you're a professional trader. So whatever money you send us, think that that's money in dollars that you have. Should be you don't need to convert it back to Mexican pesos every time. And then regarding taxes, we have our partner that will help you create whatever you need in order to create a tax efficient structure. Because if not, you just leave the investor exposed to whatever lack of knowledge they might have for taxes. So we feel that we need to provide that service to our investors. We have some others that they already have their structure. The money is already in the US. So for us, it's easier just to receive the money. But for the other ones, it's a different firm, or it's a different business within Manglar. But basically, we cover that as well.
Very good. Yeah, that makes a lot of sense. We talked about some deals, kind of how you guys find partners, how you guys allocate capital. How do you currently stay up on, industry trends and the technology, a lot of new technologies that are coming out in the real estate space? I'd say real estate is kind of behind in the whole technology, revolution overall. But, how do you as a professional, working on behalf of your clients, stay up to date with the relevant trends, either technology wise or just in the real estate business?
I would say we're trying to bring as much as we can in terms of technology, especially with AI. For example, on our development deals, we did through ChatGPT. We came up with the name, the branding, and we just gave it to someone just to create our idea. Basically, we weren't paying them to come up with ideas, so we removed that creative process and saved a lot of money and time. We also use AI to create the layouts, the floor plans of some of our apartments, instead of paying someone to do it. I mean, I think there are a lot of tools that we can eventually continue to bring to our typical process. But for example, investor reports, we can give a little bit of some bullet points to ChatGPT, and they can create the whole investor report for us. So that saves a lot of time. Emails or mail blasting type of thing. We're trying to include that in our daily activities. In some of the PropTech new stuff that is coming out, since we have sponsors in the majority of our deals, we always try to come up with good ideas, but in the end, they're running the day to day, and we don't want to mess with their, current operation. But whenever we believe that something might add value to whatever we're doing, we try to push it as much as we can. I mean, a lot of the prop tech comes on the property management side, and we don't self-manage. Most of our partners don't self-manage. It's a matter of pushing the property manager, but again, they have their own processes, they have their own thing. But I'm trying to stay on top of new technologies as much as we can. Whatever can help us save money and time, we'll probably get involved with.
And what about on so far as outside of technology? How do you stay up to speed with the pulse? Are there any kind of news publications that you think are most valuable, or maybe conferences that hey, you go to the same conferences every year or whatnot, and anything that's like a must do from your perspective to stay relevant in the industry?
Yeah, I mean, I always try to go to at least 4 conferences a year. We go to the, NMHC. We go to a couple of IMN conferences in the multifamily space, and there are some others for family office or institutional investors. Commercial Observer, BizNow conferences as well, we try to attend. So it's nothing like, meeting people in the space and learning what they're doing and try to see if it makes sense or not. I remember I was at an IMN conference here in Miami when we decided to, or I scheduled my first trip to Bentonville, Arkansas. And back then, we sold everything in Austin, or we were in the process of selling everything. And everybody was a little bit scared because, rates started to go up and people were saying, what are you doing? What's next? And I was like, yeah, I'm selling everything and I'm flying tomorrow to Bentonville, Arkansas. And people were telling me, you're crazy. What are you going to do there? It's like, you don't even know where it is in the map. And I said, yeah, I might be crazy, but, I'll see what I can do. And 2 years after, a lot of the people that I told them that is like, yeah, great things about Bentonville. Like, I didn't discover like a rough diamond, but it was sooner than it became mainstream. So, to me, it's a good pulse to go to those conferences to see what others are doing. And, maybe you can copy them or maybe just try to stay away, and that's what I did when we started investing in Bentonville. Now it's a market that is grabbing a lot of attention, for that specific market, not compared to a Texas, to a Florida. But, it's trying to stay slightly ahead of the curve, finding that alpha that we can offer to our investors, basically.
And that, like, staying ahead of the curve, does that come from having those conversations with managers, with your partners, or is that something that you're doing through, direct research, or, how did you find the Arkansas of the world? Is that from, you spoke with someone who was telling you about it, or, how did that get driven? How did you get to that point?
I mean, it's research, talking to people, conferences, but the Bentonville, Arkansas stuff came. I was Googling like, hey, the next Austin, and everybody was talking about Tampa, Nashville, Denver. There was a Bloomberg article that said, everybody has been, exactly what I said, everybody has been looking for the next Austin. Tampa, Nashville, Denver, ... Why don't you consider Northwest Arkansas? And for real. And I was like, okay. And then I started digging into the information. I was calling brokers in the area. I found out like Walmart is headquartered there, Tyson Foods is headquartered there, JB Honda, big logistic company, is headquartered there. Back at its peak, Austin, there was like 90 people moving to the area. Northwest Arkansas had like 35. So, comparing a big size city in Texas so a lot of things were matching. They have a good university there. Walmart decided to push, all their preference or preferred providers to the area. They told them, hey, listen, if you want to deal with me, you need to open an office here in Bentonville because if I want to meet with you, it's not like a guy in New York is going to figure out how they will get to Bentonville. No, I need you here in less than 3 hours. If not, there's a line of 20 other people who wanted to take your place. So that created a boom of the area. So for me, it was like reading all those articles, learning about, about that, like what we're doing right now in Wichita, like learning about, the market. I didn't know that a lot of area special industry is there. So it's just by researching and talking to people, not being afraid of, having ignorance about something.
Sounds like, yeah, like it piques interest from something, and then you've got your deeper dives on how's migration trends, what are the employers doing, what's driving economic growth, the typical drivers, but trying to get there a little bit before everyone else, before it's in the zeitgeist, before it's in the front page of the journal. If our listeners do want to reach out to you, what would be the best way for them to get in touch with you?
My LinkedIn, Eduardo Viesca, or our website, manglar-capital.com. You can reach out to us there. I'm not very active on other socials like Instagram or Twitter or anything like that, but LinkedIn, I spend quite a lot of time there reading articles or shoot us an email.
Got it. Okay, awesome. Well, thank you. Well, then, thank you, Eduardo. I appreciate your time today, and thank you all the listeners for joining us at Deal Flow. And please join us next week for another episode with an expert real estate investor just like Eduardo. So thanks so much.